You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now it's time for our final panel of the week, Embedded Optionality, Shaping the Future of the Industry, where topics will include competition and resiliency in the options industry from a forward-looking perspective. I'm going to bring Paul Jiganti back to the stage from IMC. Paul is going to introduce our panelists and then moderate this session. So please, everyone, let's give a big welcome again to Paul Jiganti.
Thanks, everybody. I'm going to actually bring the panel out and let everybody introduce themselves. Okay, I'm Paul Jiganti. I'm Managing Director of Business Development and Market Structure Strategy at IMC. Been doing that for about 9 years, came from the market making side, and can't tell you how excited I am about our panel.
My name is Andrej Bolkovic. I'm CEO at the OCC.
Shelly Brown, EVP at MIAX.
Sean Feeney, I lead the U.S. options business at Nasdaq.
Kevin McCarthy, Clear Street, CIO and Head of Clearing.
And I'd like to thank Jen and Tricia. They do an amazing job in their teams. This has been a really well-run last few days, and honored to do the last panel. But I have to tell you, I've done a little homework, and I noticed Asheville. So where is next year? So I'm going to try to guess and spoil what we're doing. So I was thinking Huntsville next year, or Libertyville. Nice, nice and close to a big airport. I think we're all going to have a great time in Libertyville. So, to get started, as we were preparing, we decided that to go forward, you have to look to see what needs to change, because you're not going to change things that don't move you further forward. So, dissecting our industry, what are the things that are impediments to greater growth? We've talked about this week the fantastic growth we've gone through for the last 6 or 7 years after years of stagnation, and what's it going to do? Like, where is it going to? What are we going to change to get a little better? And Shelly,
Well, there's a lot of ways to cause further growth or enhance further growth in the industry. One, obviously, is new products. There's been a lot of talk this week about the fact that the number of classes with options have grown from 4,000 to close to 6,000. The growth in the number of strikes, individual options traded, is almost doubled. But to provide more product creates more interest. At the same time, some of these things are double-edged swords. And we need to figure out how we manage this growth by doing things in a smarter way. How do we better add new classes? How do we better add new expirations, new strikes? There's talks about more weeklies. There's talk about daily weeklies in equities. There's right ways to do things and wrong way to do things. I think we just need to better manage that, and that'll further the growth in the industry.
Now, Andrej, you had some interesting stats for us.
I happen to bring some interesting stats with me, thanks to my team. So when we look at the strike listings and we talk about growth of the industry, I think it's also important that we manage that efficiently, because it uses capacity, it uses resources. So if we look at 2020, there were roughly 920,000 equity ETF series listed, compared to almost 1.6 million in 2024. So the number of underlyings have grown, but not at that same pace. So it has to be in more, time frames. But then when we look at the open interest numbers in those strikes, it's interesting to see that 30% of the equity options strikes have no open interest. On the equity ETFs, it's close to 60%, and on the index products, it's 50%. So a lot of that is also in ETF products, where we notice that we've got 1,600 ETF products listed, of which 800 have less than 10% in open interest. So that is obviously a tax to the industry. It's a tax on capacity, and it's something that we need to consider. How do we grow further, and how do we use that capacity that's out there in terms of capital and liquidity in efficient ways?
Kevin, you're nodding your head.
Yeah, I mean, I think the stats are compelling, right? I mean, the growth of the industry, trajectory of the industry, the panel before talked about, Europe or non-US into US, the constant flow that wants to come in. So the growth is there. I think how do you handle it, as Andrej points out, it's how do you manage it? We've had a lot of healthy debate about strike listings over many, many years in conferences, and yet we don't seem to be able to conquer this beast. When you talk about resource, I don't want to be negative, but I think the resource and constraint, the way I look at it from a post-trade perspective or a clearing firm perspective is, the market makers have to quote. And for that reason, you may have a position in something that maybe you really is much more esoteric or doesn't trade very often. I know we're talking about concentrated stocks and Tesla and everything else, but in some of those more esoteric names, you have to quote, you have to consume the market data, you have to have a position, you have to fund the position. That position funding may not be at the level that you would expect it to be. There may not be an offset or a hedge that might be working well, right? And as a clearing firm, when I look at a portfolio, as a consideration about how do we want to manage this business or a particular client, how do we provide the best optimized funding? Well, these positions are a lot to consume. There could be thousands upon thousands of positions that may not even work in the industry from a functional perspective. The operational component of this, it's not just a clearing firm, it's how we interface with OCC and others. These interfaces have to really be very robust to handle these types of portfolios. So I think that there's inherent costs that are not always understood, and I think that the transparency could be better. So I don't want to be negative, because I think for someone like ourselves, Clear Street, coming into the market shows there can be a new entrant. The hurdle's quite high, the bar is high. So I think the consumption rate for this issue, which may seem small in some ways, right? Like strike listings, not interesting, but in the end, it has a tremendous amount of impact to the industry.
Yeah. And this beast that Kevin is really referring to is constantly changing, right? So we're making the right strides in terms of putting the right product in front of people. We're making the strides in terms of putting the right strikes, and it's really an optimization problem that we're looking to solve for, right? So as we continue to move forward down the path with new products that are being offered, and we're looking into this demand, being able to optimize to the strike profiles and try to limit the number of strikes that have zero open interest, through some possible use of artificial intelligence to do so, is one way that we can really tackle this beast that has been, just in existence to the industry for what seems like forever.
The problem people don't realize, well, Sean and I agree on this topic, but we can't talk about this topic. The exchanges who list the options decide to list what expirations and what strikes, whether it be breadth of strikes or density of strikes. We can't communicate with each other and do something that makes sense because our hands are tied by the regulator. There was a settlement with the Department of Justice many years ago amongst the original 4 options exchanges that restricted the exchanges from communicating with each other on listings. That was specifically about listing of individual classes. Now everything's multi-listed. The reality of the world today is if I list something, Sean's going to list it tomorrow, all the exchanges are going to list it. But we can't talk to each other and say, does it make sense on a 5-week weekly in NVIDIA that stacks $900, should we have strikes from $500 to $1,600? Should we have $2.50 strikes in a $900 stock, which is like a 25-cent strike in a $90 stock, or a 2.5-cent strike in a $9 stock? Nobody thinks that's a good idea. But to get to a point that we're doing things that make more sense, we have to be able to communicate. We need the regulator to step in and allow the exchanges to sit down and do what's right for the industry. And it helps the market makers, it helps the clearing firms, it helps the clearing houses, it impacts OPRA, it impacts CAT costs, it flows through the entire industry, and that's an impediment to growth.
And strike breadth, strike density, and we are underneath this regulatory umbrella where we just can't even open the conversation except if we're in a committee meeting with the regulators present, or if we're going into a client and saying, hey, this is what I think, can you please relay this? Because it's not, what we're looking to do here is an industry problem. It is not a competitive issue, right? That 2000 settlement we're 24 years removed from it, right? And we've been talking about these antiquated rule sets that have been in existence, and they are still there. So from a regulatory perspective, we really need to try to impress upon those regulators that these rule sets need to be updated. They need to be brought into the modernization, into the modern age, and they just need to be simplified to what we're looking to accomplish. We're not trying to do anything nefarious here. And Shelly and I absolutely agree on this topic and many others specific to that settlement and the conversations that should be allowed to be had between different exchange groups and participants.
So there is a glimmer of hope on the horizon that talking to the SEC folks that handle our marketplace, there is some movement towards the OLPP, Options Listing Program, I don't know what the other P is owned, it's a NMS plan light. And if that plan gets two exchanges, could even be from the same family, together to decide that they want to change it and give it an advisory committee and the other things that make it a true NMS plan, that you could all get in the room. So there is a chance. It looks like there potentially is a path forward. I think we'd all be very happy with that.
I think the positive thing as well is that there's general alignment, which, some of the topics there's sometimes debate and discussion. But here we see, it's from the trading firms, the clearing firms, the exchanges, and the clearinghouse that, feel that this is something that, we're aligned on what next steps could potentially be.
Yeah. Well, so that's good. So now then, if we have this expanded bandwidth, where do we go with it? Do we go into 24-hour trading? Is that really where everybody wants to go? We've all have the extra 18 hours that we're not trading on the U.S. markets. What are you going to do? You can go home.
If we believe there would truly be real growth commensurate with those extra hours, we'd be in favor. If it's simply taking the existing volume and spreading it out over time, that makes no sense. We were talking earlier about this and used the Amazon example. You can get online at midnight and do your shopping on Amazon. Does that create additional things you bought, or did you just choose to buy it at midnight because it's convenient for you? And if they were only open from 8 in the morning to 4 in the afternoon, you would have done it during the day. That's really the question, because there's so much operational cost and risk added by extending hours. There's issues of corporate actions, which you mentioned earlier, and rolling systems over. If there's going to be real growth, it may be worth it, but don't know.
Liquidity fragmentation, and the liquidity on Amazon at midnight is the same as the liquidity on Amazon at 2 p.m. or any other time during the day, right? So as we look to this 24/5 concept, extended trading hours specific to individual single stock equities, we really need to consider all of the downstream ramifications and exactly what the target audience for these instruments would be.
Kevin, life gets easier if you're going 24 hours a day, right?
Yeah, much easier. Nobody goes home, no need to sleep, you don't need an apartment, rents are high, stay at work. I think, it's great to see that the industry is attracting a lot of growth, and I think this is obviously another way to try to capture some of that, but it does come with the inherent problems, as Shelly and Sean mentioned. And I think, it's exposure, right? It's not like buying headphones at Amazon at 2 a.m. You're creating exposure, you have risk, someone has to monitor that. Again, you're back to the market data. Again, not to be negative, but how much of that volume is really going to be inspired from this extended hour trading or 24/7, 24/5? You see it in the crypto space, obviously, and it's very interesting. I was in a discussion with a client some years ago, and they took a margin team that was dealing with their typical, capital markets and equity market structure, and they tried to apply it to their new crypto business. And, the person was like, where's the closing price? Right? And so you think of these practical matters, and it's a real issue, right? So how does a clearing firm that tends to, or most of us, that have an end of day, what's your end of day? And then if there's an end of day, that's great. What's the exposure that happens post your end of day until your next day? What's your open exposure from a settlement risk perspective? What are your obligations? If you're a U.S. firm and you're under U.S. reg, which we are, right? Then you have your regulatory construct about financing and capital and all these other things. So I just think, I don't know that we always get into it fully knowledgeable about all of these pieces or even transparent. So it has a great headline and you put it out there and then it's for someone else to figure out, right? And you see that all the time, with some products where there's not really a completely thoughtful process around what could the impact be and, how do we mitigate those to actually provide a safe market, to provide that safe entry. So if there's a retail customer sitting out in Korea or somewhere, they need to do the next trade. And there's a tremendous amount of wealth in a lot of other places outside the U.S. that want to get there. Is it safe enough for them to be in? And can we actually manage it? I think that's part of the question.
I think for a lot of companies, there's obviously operational and risk concerns and things that happen, throughout the night and, changing day over day and what is the new start of day and what is the risk position that you're actually looking at. And, while I can understand that, even trading from, maybe potential clients from Asia into the US, that it would be more convenient to trade at a different, more localized time zone. That doesn't mean that, through the normal US trading day, that risk doesn't have to be managed and that, those processes have to be up in the line. So I think that the challenges are definitely there and, the liquidity concerns overnight are also legitimate.
So going back to the idea of giving the consumer what they want, it appears they're voting with their order flow, that they want shorter and shorter expirations. And, I liked what Q said yesterday was, I think it was Q that said it, the duration of holding of equities is very short now compared to in the past. So it's not surprising with our access to our smartphones and ability to trade all day, unless you work for a broker-dealer, and then you really can't. But the consumer does, and they're trading these daily options. Is that something that we're going to see that's going to leak into Amazon and Tesla?
Does retail understand what they're asking for?
Well, I don't know if it's retail that's asking for it.
Well,
the retail customer, yes. Retail firms,
customer, yeah. If we were to allow that to happen, and I see pluses and minuses. There's a tremendous amount of volume in the weeklies that expire Monday through Thursday in the ETFs and the indexes. There's a different kind of risk in those products versus equities. The binary event risk after the close for the contra exercise. And the retail public has never had to deal with that. You generally don't have earnings on Fridays. And it's that unknown risk. And you never want to be the cover story of the Wall Street Journal. And what happens if there's an event, if there's an earnings announcement and exercise happens for strikes that were $20 out of the money but are truly going to be in the money. I don't know how we solve this problem, but we have to be smart about how we do this if we move forward.
Mm-hmm. Yeah, I mean, I know there's been thoughtful discussion around it, and you've been part of it, and Sean's been part of it too.
Just a little bit, yeah. In terms of the operational risks that exist, they're not going anywhere. There really isn't a way to collapse any of that contra exercise window. So from a listings component, what the exchanges can really do is limit the breadth and density of the strikes, limit the number of names that would be eligible for this style of product. And then we're really in a place where we can't exactly ask these firms to delay their earnings release or move them to a different time, right? Like we're not in the business of changing corporate governance at the the corporation level. So we don't have a real wonderful answer for this, but if we were to just continue to limit these risks and continue to perform the education to the end user, which I think is the real long pole here, because you have to educate people that have been trading options for their entire career, and then as people have, as time ends up going by, the actual demographic of people who are trading and how they are trading continues to evolve and continues to change, and the demand for these instruments continues to also increase. So we have to consider that these risks may be acceptable, and then we have to work with the segments of and the businesses that are really absorbing a lot of these risks, which at this point in time are the retail firms, and we need to try to figure out ways to remediate or mitigate these risks in order to provide the product that people want to trade, and then be able to list these products responsibly and suitably, and then allow for the regulators to make the decision as to that suitability.
It's funny how these problems interplay, because this goes back to the communication for listings. Somebody said, well, just don't list options on the Wednesday that XYZ announced as their earnings announcement. How do we coordinate that? We can't.
Well, get the OLPP fixed. You're all set.
I'm all in.
And we're going to be listing, or we're going to be filing to list Mondays in the GLD, SLV, TLT, UNG, and USO options, and that'll probably come within the next few weeks. And we're going down the path. We have to acquire all of the data, and what in the conversations that we've had with the commission, they're asking for us to structure these filings in a manner. And what that tells me is that the commission continues to seem to be open to the expansion of product, at least in the ETF space.
You're not supposed to tell me that.
Well, I didn't tell you. I told everybody here.
He wasn't asking your advice on it either.
Worst kept secret on Wall Street.
Kevin, does this impact your business at all?
It does. There's a different issue I'm not sure everyone's completely aware of. I'm not suggesting people don't know it, but that the exposure, when you think about expiration, it is removing some of the risk, right? But there's a daylight requirement that actually gets exposed when that expiration happens. So, for clearing firms, and Andrej certainly knows this very well, the exposure that happens between like OCC and NSCC is exposed then through that period between that action of the exercise and the settlement of the full process. That creates another capital draw and a liquidity walk that's required from a clearing firm perspective that you have to post for, right? So we know the risk is actually taken off, but the way our market structure works is it says it's exposed because the settlement cycle hasn't happened yet. Now, T1 does help a bit, but it doesn't remove that overnight. So you're required as an industry to put that additional capital into the marketplace. And that actually, so as much as you're removing risk, you're also holding back liquidity because that gets locked up, right? It can't be released until the next week. So if you think about the Fridays and the expirations, these things are happening all the time. And that's just another kind of consequence that happens in the marketplace, which has to be considered.
Andrej,
We're obviously, looking at the development of definitely the shorter dated options and more importantly also the 0-day options and how we perceive that risk. And we do also have some changes that will be up and coming and that we have draft rule filed with the regulators that also look to capture some of that exposure which is not core or visible in overnight margin because they expire the same day. So that's something that we also, as the market evolves, we need to evolve and we need to adjust to capture that as well.
So Kevin, going back to your clearing and settlement question, if we get to T plus 0 minutes, does that answer it for you?
I think potentially, I think that certainly helps. The closer that we can normalize that actually what I consider to be inaccurate risk, I think the better it is for us as being part of the market structure from a liquidity provider perspective. Yeah.
Yeah. I mean, totally veering off the path here, going towards way down, like talking exchange trading floors. And strangely enough, this is not a 1973 discussion. This is 2024. We're still talking about trading floors, which, everybody was fessing up about yesterday on one of the panels that they thought mini options were going to be the answer to everything. I was in that boat, so I was wrong. The other thing, one of the many other things I've been very wrong about was the existence of trading floors. I did not think they would be here in 2024 when I walked off the SIBO floor in 2005 or 6. They're viable, they're vibrant, and we're going to have a new one. So, Shelly?
Well, we've seen what happened after COVID. The floors shut down in 2000, and we didn't know if the volume was going to come back, and it did. So it proved that there is a place for trading floors. We've seen a lot of interest in the new trading floor. We've seen a few of the other dinosaurs, like you and me, that said if we were to go back to A's and quarters, we'd go back to the floor as well. But the reality is there's still a fair amount of volume done on the trading floors, and it's a competitive business. We saw a new floor open several years ago, and they're flourishing. That gave us the thought that we will do the same thing. We want to be competitive. We were the only exchange family without a trading floor, and of course MIAX has since started, so I'm not sure what their plans are for a floor. But it's a competitive business. We believe that our technology and the way the technology will help both the market makers and the floor brokers on the floor will be a differentiator. You don't think of a trading floor and technology go together necessarily, but they actually go very closely together. So we're very excited about opening the new floor. Plus the inherent advantages. One, I've been asked for the last 14 years, why are you the Miami Exchange, but you're in Princeton? Now we're actually going to have a Miami Exchange. And for the floor brokerage community, they can come from New York, San Francisco, Chicago, or Philadelphia and see a substantial increase in take-home pay due to the state tax rates.
Yeah. So, Sean, you're an owner of some real estate.
We've definitely got some real estate, and there is viability to trading floors. There's volume that trades there, and we have to ask ourselves, what is the nature of that volume, right? It's typically OTC risk layoff from banks through interdealers and down to floor brokers, and then portrayed on the trading floor, and then subject to price improvement, and then there we go, it hits the tape. So what Henry portrayed in the beginning of the conference during his industry update is that the trading floor volume overall has been static, right? While the electronic volume in the industry has grown. So we definitely see that the trading floors and the need for competition among those trading floors is certainly something to be mindful of. That said, when it comes to volume that is trading there, we really have to say, well, how does that grow? And as the real assets at some of these funds that are trading with their prime broker or bank counterparts and then sending those orders through the cycle ends up coming down onto the floor, then how is that business going to grow? So we're looking at the vanilla listed option space, but a lot of that volume does originate through OTC and risk layoff. Right? And then there are other strategy style trades and more complex orders and things that are tied to stock, and then some more live orders that will end up down on these trading floors. But the environment of these trading floors is fairly tenuous. I mean, you have market makers who are on the trading floor that are looking to transact and to give better pricing to the orders that are coming down to the floor. And you have floor brokers who typically come down to to bring orders down to the trading floor that are packaged and paired already. So there becomes this kind of conflict of interest, because when you have market makers and a bunch of different market makers that need to populate multiple floors at one point in time in order to make sure that we have a perfectly competitive instance when each one of these orders comes. And now it's like, okay, well, the more competitive a floor is, the less competitive a floor is. Because the more market makers who wish to interject themselves, drives business away from that trading floor to a floor that might be less populated. So there's a chicken and egg problem with floors, but in terms of the overall volume, we absolutely believe that it exists, and we certainly welcome the competition. And Shelly, good luck on the launch.
So, if we're looking 10 years from now, are we going to be standing in our, not me, but standing in your living room with a VR headset and click from, I'm on Miami's floor, I'm on Philex's floor? I mean, is like, let's get creative. Think, can you see a world where that's where we end up?
Certainly possible, but it's not going to be my world.
I mean, I've seen it before, maybe not from a expansive perspective, but there have been many clearing firms that have done this for some time, right? They've been broadcasting to each other in their own networks, and virtual trading floors have existed for some time. I think it's just not been socialized in a way where it's mixed participants in a virtual manner. We're already doing it electronically, right? So it's already out there, the market's there. It's just a matter of, is it a VR? So I think it's possible. I think, if you think about gaming and the interest that everybody has around that, especially in the younger generations that are, like, you could see that being very interesting to people maybe, getting into the industry, if there's anyone getting into the industry. I think it could be very interesting for them.
And in the electronic space, we have all of these different functionalities, and each one of them have specific nuances. And then on the trading floor, on each one of the trading floors, the workflow is actually also very different, right? So if you have a different workflow and a different construct to the floor and different manners in which the competition for these orders is being presented to the marketplace, then there exists some other problems. So in terms of like trying to harmonize things, when I started on the trading floor in 1999, broker walked into the crowd, 110 bid for 2,000 at 115 sold was something that happened. And now the trading floor seems to be more of a negotiation market because these orders are really packaged, and they're just saying, I have 2,000 to cross at 110. Does anybody care? And that's just the difference in the way that things have evolved on the floors or devolved on the floors in a way is really, I think, inhibiting competition and real true price discovery.
Would the VR headset help?
Yes.
Okay. Yeah, I don't know. People, you see things in the internet, and I think sometimes people say things and do things when they're hiding behind an avatar that are different. The thing that worries me is, I am old school. I started in the SIBO in 1980. And there was a time when, Paul, you were there at the time, and we'd look at each other in the eye, I'd say buy him, and you say sold, and there were no lawyers, there were no contracts, there was never a second thought in our mind that the person on the other side of this trade the trade's gonna be clear and be there in the morning. I'm not sure if liquidity somewhat goes away in a virtual world, that honor that was in the pits that we still have in this industry, and I think it's one of the most important things in this industry. I would be very scared that some of that might go away.
Mm-hmm. Yeah, interesting.
Harmonize the workflow. Harmonize the workflow.
Yeah, I think harmonizing the workflow has some disadvantages, personally, because you get diversity of thought and diversity of the workflow, which gives you a potential to have a different outcome and a different creativity to move forward from there. And so it seems to me, dude, guess it's slightly safer, but I'm just the moderator.
I agree with Shelly on the concerns of distant communication and how that should evolve or how that could evolve. Just thinking about my own daughter and some of the communication I see happening, between kids on social media, because you don't see who the person is on the other side. There is some element of concern on how that would evolve.
Yeah. So again, looking 10 years from now, we've got since the 34 Act of 1934, we do a lot of things have tried to fit into that box. Is there any chance that you see the SEC, CFTC, and potential global regulator for crypto merging? Like, do you see benefit from it?
Is that for me?
Sure.
It's an interesting topic for sure. I think it's gathered a lot of interest from the wider audience as well as the regulators. My personal thought is I don't see that move very fast. There's definitely things that have to be settled at the SEC side as well as on the CFTC side. But so far we've not seen a merger happening on that front. And I'm not entirely convinced that will happen anytime soon.
I think there would be much greater efficiencies if like product were regulated by a single entity. The fact that in the equity world, you have the S&P futures and all the equity-related futures regulated by a different entity, and seems to be a different playing field on the rules. As part of that, we've actually been impacted by that disagreement between the SEC and the CFTC in some products. I would love to see greater coordination between them and like products. I think we need to figure out where crypto ends up, make a decision, and let's move forward. Yep. The battling between the agencies is nonsensical. Some of the things that are the result of the 34 Act, while the intent was all 100% for the good, how can we decide? I don't understand how an ETF on a cryptocurrency, that they can be deemed to be securitized as an ETF, but you can't have options on that ETF. Those don't go together in my mind. The different ways that the S&P futures are regulated versus the options and the cash options in the S&P and SIBOR are regulated, those things just don't make sense to me. They're not harmonized in any way, and it makes the market inefficient.
We have no opinion, right, on these products. As long as we can operationally handle them and we can risk them appropriately, that's not something that we discriminate against in any way, shape, or form, whether it's CFTC or SEC regulated. There just needs to be clarity on how we want to manage that.
Same answer to the floor and virtual floor, and it's harmonize the workflow. Right? When a regulator whose job is to protect the customer, to protect the end user, should not be a political situation. When you have multiple entities that are regulating and have varying opinions and multiple people within these entities that have varying political beliefs, it starts to inhibit the workflow. So as regulators, take that in mind and understand that the job of the regulator is to protect the end user, we need to do our best to maintain consistency between these regulators and their processes so that we don't have to change our arguments legally in order to comply with the Securities and Exchange Act of 1934, and maybe, do you think we should have a Securities and Exchange Act of 2034?
Good idea, because I'll be gone.
Sorry. I believe it's the Senate Agriculture Committee that has oversight over the CFTC, which makes sense given when that was created, most futures were agriculture futures. With all due respect to that committee, how do they know how to regulate a securities index? Why wouldn't that be under the SEC?
Definitely a thorny issue that we all have to deal with. I know it's more expensive for all of us, and I know it's more expensive for the lobbyists having to deal with.
Harmonize the workflow.
Please.
I'm with you on that one. So we just have a minute until noon. I know that's when the announcement for the
Libertyville?
For Libertyville is going to be done. Sorry, Tricia. And I just want to thank my panel, thank all of you, and thanks OIC.
Thanks, Paul.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.